Welcome to MacroPulse. Today we're going to focus on the South African economy. We're going to look at the performance of 2024, some recent economic developments, as well as what we expect for the economy and asset classes over 2025. Now there's still 1 month left to this year, but we can agree that thus far the markets have done really well so far this year, with South African bonds up 17%, outperforming South African equities, and it has been probably the best month or year for SA bonds in the last 20 years. SA equities did 14%, but there was a lot of dispersion amongst the different sectors. In particular, those sectors and equities that's linked to the South African equity market did very well. SA general retail did well, close to 40% up for this year thus far. SA property was up about 30% thus far this year. And then also South African banks and financials is up between 20 and 25% thus far this year. Resources, lagged a little bit. They were flat, but even there we saw a little bit of dispersion, with gold miners up quite strongly, 40%, but diversified miners, PGMs and energy all down more than 20% this year. The big names like Naspers and Prosus, they were up about 30% this year. So a lot of dispersion amongst the different equity names. The local currency also did well this year. The rand is up about 1-2% for the year, outperforming many of its emerging market peers, which is in many cases down more than 10% for this year when you look at the Mexican peso, the Colombian peso, the Chilean peso, Turkish lira and the like. So on an absolute and relative basis, South African equities and assets did well. South African equities outperformed its emerging market peers, the bonds outperformed its emerging market peers, and so it has been a fairly defensive play within the emerging market space. It also has been a very bifurcated year, in that the first 5 months to the year, prior to the election, we had some sluggish performance amongst the different asset classes, but then saw a very sharp re-rating and outperformance of the last few months after post-election. Now the question is, did the market, and in particular the equity market, rally too much? Did we see too much of a re-rating taking place? Are valuations high? Now to answer that, and in our view, we think that there's still more scope to come, both on an absolute term as well as on a relative basis, that SA assets can perform still well. Now to answer that, let's first look at the economy and what's happening in the economy, because it's ultimately economic growth that drives earnings growth, that drives equity performance. And if you focus on the economy, then we are seeing that interest rates are still coming down. The SARB will continue to cut rates as inflation remains low, and other central banks across the world, in particular the core central banks, continue to cut interest rates. So we think there's more cuts to come than what the market is currently pricing in. We also see inflation remain low at below 3%, and we expect that to remain below 4.5% until the middle of next year. And so while inflation is low, rates are falling, and the fuel price is coming down, we see more of an increase in disposable income. People are able to spend more. Disposable income is also supported by the fact that wages are rising faster than inflation, but also we did see that jobs gains in the economy has risen to 300,000 in Q3 of this year. Further, the two-pot system, what we know thus far is that the withdrawals out of the change in the two-pot system is quite substantial and able to cushion some of the spending that's taking shape in the economy. It's one thing to have the ability to spend. It's another thing to have the willingness to spend, and their confidence is key and important. If we look at the economic indicators from the Bureau of Economic Research, they are showing us that consumer confidence and business confidence is steadily rising. We're also seeing that playing through in the likes of private sector credit that's rising now in real terms. Vehicle sales is also quite strong, in particular passenger vehicle sales. And just more recently, Black Friday, we saw that according to eCentric, which represents 20% of the card spend, that year-over-year transaction values are up almost 50% just on Black Friday alone. And thus far for Cyber Monday, we see a similar trend taking shape. So overall, we think that people are more able and willing to spend. Confidence is rising among businesses, and fixed investment is also on the rise. We are seeing that people are feeling more optimistic. The network economy, in particular electricity and transport and logistics, is improving, and that is starting to have an impact on how people also perceive the new GNU, and that the GNU will be able to drive reforms in the economy further. So as a result, we see that the country's risk premium is also coming down in the sense that S&P Credit Ratings Agency recently increased the outlook from stable to positive for the country, and there's real optimism that South Africa can be taken off the FATF grey list in 2025. The recent appointment of Ebrahim Rasool as the ambassador to the US for South Africa is also key in stabilizing the relationship between South Africa and the US. All in all, if we take all of these factors into play, we see decent improvement in earnings playing out over the next 6 to 18 months. We see that if economic growth is 2 to 3%, and we look at the past, valuations typically is about 10-20% higher in environments where we see higher growth. So there's scope for valuations to improve, but it's really earnings growth that's going to come through and which we are focused on. And so from an absolute as well as on a relative basis, we think SA assets, both equities, bonds and the currency, has got scope to improve over 2025. So what about the risks to this view? Well, let's focus on the global risks, because we believe those are the key ones to watch in 2025. First of all, Trump's policies are quite inflationary, which means that he may curb some of the cuts that the Fed or the market is pricing in for the Fed. Ultimately, that may mean that the SARB will cut by less than what the market is expecting at this stage. The other risk is that due to Trump's trade tariffs, we may see slower growth emanating from China as well as Europe, key trading partners to South Africa. And so those are things that we will watch. But SA Inc. in particular is quite insulated from the trade tariffs and from the global economy. And we believe in 2025 it may be a defensive play while we see local dynamics still improving and while we see the expectations of growth still rising. At this stage, the consensus only expect SA growth to be 1.7% for next year, and we think there's a recent chance that it could be between 2 and 3% for next year. The second risk is China's growth. We've seen the Chinese growth has disappointed this year, but we've seen a definite shift being taken during September by authorities in China really trying to focus to bring growth back into the economy. And if you look at the PMIs and some of the property sales numbers, we are starting to see a little bit of stabilization taking shape there, and we believe that fiscal policies that will be released for next year will be constructive and conducive to support growth. So we think the Chinese growth cycle should pick up over next year. That's all for this week. See you in the next episode.